Okay, good evening, everybody. It is September 30th, 2022. It is the official last day of the month, last trading day of the month, and last day of the quarter. So we have now closed out Q3 officially, headed into the last quarter of the year, the last 3 months, already October starting tomorrow. Now, if you remember all the way back, I want you guys to put on your thinking caps here and think all the way back to the beginning of the month, September 1st. And I want you to remember what we talked about on that live stream. And one of the things I said is that after Labor Day, okay, after the big hoorah of summer, that is when volumes should start to pick up on all the exchanges. And I'm talking about trading volumes on Wall Street. Okay, so after Labor Day, after the holiday, all of the major money managers, hedge fund managers, pension fund managers, all the big wigs on Wall Street return to their offices in Manhattan and around the world. Now, what does this mean? Usually means an increase in volatility, and historically, September is the worst month for stock performance. Now, if you remember what I said, I said that I think September was going to continue its tradition of being the worst performing month for equities. And this month was absolutely no exception. So being that September is usually the worst month for stocks, September 2022 is no exception. The Dow Jones Industrial Average today dropped about 500 points, ending the month down around 9%. The S&P 500 was down about 9.3% on the month, and the NASDAQ got hammered the most, down about 10.5%. So we'll talk about what this means. We'll talk about why this probably happened. Obviously, the statistics weren't on our side, and we are going through arguably one of the most strong and powerful monetary tightening cycles we've seen since the 1980s. One of the things we're going to be talking about, everybody, is we got some big inflation data out, okay? And it is not good news. Inflation accelerated more so than many economists on Wall Street projected. Now, this is the Fed's preferred gauge for inflation. This is called the PCE. And as we know already, Fed Chairman Jerome Powell, as he stated at the FOMC meeting, or the conclusion thereof, that they will be increasing the tightening on monetary policy until they can see conclusive and concrete data that inflation is slowing. Now, this isn't going to help, and I think this is why the markets accelerated the sell-off into the close, because the worse the inflation data is, the further away we are for any type of quantitative easing, okay, or maybe just even a holdup in interest rate increases. So we're going to talk about that today. We're going to go line item by line item, talking about the PCE, which is the Personal Consumption Expenditures Price Index. We are also going to be talking about some statements that we heard from Fed Chair Brainerd. And then we're going to talk about some go-forward predictions for Q4. But first, let's see who we have in the chat. Let me close up my laptop here. And I'm wishing everybody a very, very happy Friday and start to the weekend. So just give me 1 second and we will get started. We are broadcasting live from the one and only 200 Southeast Financial Center. And we're going to be walking around downtown Miami, walking up to the FTX Arena. So just give us 1 minute and we will be good. Hey, Daryl B is here, Sunshine After Rain, FredX. Welcome, everybody. Hope you are all well. So one of the interesting things that we're going through here in Miami is the king tides. Is anybody familiar with the king tides? Now, I was in North Beach a little bit today. And I have never in my life seen waves the size of the waves that I saw today. Now, usually the water in Miami is crystal clear, like glass. But today it was looking like Jones Beach on a very, very rough day. And I guess it is because of the king tides. So we will be talking about that a little bit. Ryan, we're gonna have to get you out of here. So let's see who we have in the chat, my friends. I see Austin City Limits. I see Jeremy is here, says good evening. The ABX girl says, hey all. ABX girl, hopefully you are safe from the hurricane as it is headed towards the Carolinas, so please be safe. Gustavo is here. Rafed says, hopefully everything is better there. Thank you, my friend. Michael is here. India 1920s is here. This is very pleasant. I see Corey. Sunshine after rain. Karen is here. Says hello from Brooklyn, New York. Welcome to all of our Brooklyn friends. Golden's Dawn and FredX. So we will start the stream. I'll give you one more look at the office here. This is the WeWork at the 200 Southeast Financial Center. Now, I think there's some sort of concert going on at the FTX Arena. So we'll be seeing what that's about. But this was a brutal, brutal month for the stock market. But September is historically a very terrible month. Hey, Will is here. Ken Glass is TGIF Tom, welcome. I see Joe Driver. Kevin Ramsey says hello from Cincinnati. Good to see you, Kevin. Hopefully the internet doesn't go out in the elevator. Hey, Dow Jones, what's up? I'll give you guys an overlook of the place. I see Andy is here from South Korea. Good to see you, Andy. DowJones.eth. Welcome everybody. The ABX girl says I'm okay. Raleigh and Durham has trees down. Maria says Sabbath Shalom. Thank you so much. I appreciate it. Good to see you, Maria. All right, so now we are officially outside. Happy Friday, TGIF to everybody. I hope you all have some fantastic weekend plans. So one of the things that we're gonna be talking about tonight, we're gonna do a quick September recap and review. So as we've been talking about, I want you to think all the way back for the people who have just been joining the stream. You know, one of the things we were talking about at the beginning of September, right? Usually what kicks off, I would say, the return to reality, back to the office, is usually the conclusion of Labor Day. And after Labor Day, that's when all of the big, I would say, decision makers on Wall Street are back at their desks. So we usually see an increase in volatility, an increase in volume on the exchanges. And historically, from a price performance perspective, September is the worst month for equities. And September of 2022 was definitely no exception. We had the Dow Jones Industrial Average drop about 9% for the month. The S&P 500 was down about 9.3%, and the NASDAQ lost 10.5% on the month. Now, if you've remembered, at the beginning of the month, I said that I don't think September is going to be an exception. I think the price action in the stock market is going to be very negative, and maybe even more negative than in years prior. And the reason why I believe that is because we are entering, or have already entered, a pretty unprecedented monetary tightening cycle. Okay, the Federal Reserve has now raised interest rates by 75 basis points back to back to back with no end in sight. We got inflation data out this morning, and we heard from Fed Chair, or Vice Chair, I should say, Brainerd, excuse me. And she confirmed our thesis. that even if we get better than expected inflation data, they are not going to pivot monetary policy from tightening to loosening monetary policy, because they do not want to repeat the mistakes of the 1970s or get too premature with pivoting their monetary policies. So the market got slaughtered today, hammered, clocked, whatever type of onomatopoeia you want to use. And I think the reason for that is because we got worse than expected inflation data. So the PCE came out today, and it showed inflation accelerating at a higher than expected rate. So beating out all of the major economists' expectations. And once this data came out, markets really started getting hammered to the downside. And I think that just confirms the notion that if we keep getting horrible inflation data, the Federal Reserve is going to continue to get even more aggressive with tightening monetary policy. So we'll talk about that. We'll talk about what that means for October a little bit later in the stream. But for now, we are outside Bayfront Park on Southeast 1st Street. It is a beautiful night. It is roughly, I don't know, I'd say maybe 75 to 78 degrees, very low humidity. Beautiful night, beautiful Friday here in Miami. I see Daryl says, good evening, Tom. Good to see you, Daryl. Welcome. Cayenne Pacific says, hey, Tom. Seems like Miami hasn't been turned into a water park tonight. Yeah, it has not. Cayenne Pacific. Oliver Crane says, hello from upstate New York. Good to see you, my friend. Welcome. I see FredEx, Sunshine After Rain, Dow Jones. Dr. Longus says, I think we're already in a 1970s style economy. Well, technically, I think you'd be right, Dr. Longus. I'll give you a quick shot of the 200 Southeast Financial Center, where we just were coming down, working out of. And so we've had 2 consecutive quarters of GDP contraction with accelerating and ramping inflation each time. So technically that is definitely stagflationary. Now, the interesting thing, I was actually talking with one of my buddies today, and there's no guarantee that even if the Fed raises rates, there's no guarantee that that solves the inflation problem. And I think we need to be aware of that. But from an investor's standpoint, from an investor's point of view, I always like to take, or the frame of mind, to say, look, the Federal Reserve is going to do what they're going to do. It technically doesn't matter if I agree with them or not. What matters is I take the data that I'm given, and the data right now unequivocally says that the Federal Reserve is going to continue to increase interest rates and allow assets to roll off the balance sheet. And obviously, as we reviewed, assets on the balance sheet conclude or is inclusive of US Treasuries and mortgage-backed securities. So it doesn't matter if I agree with what the Fed is doing. I just need to be able to understand what the Fed is doing so we could best position our portfolios. Because I've been seeing a lot of back and forth here on a lot of the mainstream financial channels, Bloomberg, CNBC, with a lot of people and even academics too, some very notable professors that we talk about a lot in the streams. They're getting so frustrated and furious at the Fed. And I get it. I totally get it. I mean, but at the end of the day, I think you guys know my view on this, is that we've been in this scenario of kicking the can down the road since the lows of the 2008 GFC, or the Great Financial Crisis. And we're going to have to pay the price someday, right? We're going to have to pay the price at some point. So to sort of throw your hands up in the air and kick and scream and say that Fed Chair Jerome Powell is, an evil person for raising rates, I think it's a teeny bit disingenuous, because, even if we think about it from a political standpoint, from Democrat and Republicans, it doesn't really matter who's in the White House, because whenever the Fed tries to tighten monetary policy, regardless of who's in the White House, they throw a fit, right? If you guys remember all the way back to when Fed Chair Jerome Powell wanted to raise rates when Trump was president, he threw a big fit and he said you're going to crash the economy, and he actually threatened to fire Fed Chair Jerome Powell, right? And not to get too political, but the point I'm trying to make is that much of these equity and stock market returns, positive returns, has been due to easy money, right? Quantitative easing. So we've only just begun the quantitative tightening cycle, and things are already starting to break, right? You just saw a central bank, Bank of England, actually have to come in here and intervene, because not only is the US bond market reeling, but global bond markets, you're seeing rates absolutely blow out here. So, I mean, how much more can this bond market take? I don't know, but we'll talk about it. We'll definitely talk about it. Hey, Will says, I like Meet Kevin, but every thumbnail has the world ending, and I just can't stand clicking on those videos, says Will. Jay Sully says, Volcker it. Yeah, so Jay Sully, yesterday we were actually talking about, I gave everybody a task to read Paul Volcker's book called Keeping at It. I think that's what it's called. It's a Friday, my brain is fried. But I think, if we think back to what Ray Dalio says, and I'll say it again, Ray Dalio, Paul Tudor Jones, Stanley Druckenmiller, they say the best investors are the best students of history. And right now, we are in an unprecedented cycle of quantitative tightening during a period of high inflation, which is very notable to 1980s style inflation, right? When Paul Volcker was Fed chair, in March of 1980, he was tasked with dealing with 14% inflation. And we all know how that turned out. He had to bring rates up to 20% to get inflation back to 3%, which was the target, although it didn't come without a cost. And that cost was a massive blowout in unemployment. Check out the amount of water that is pooling up here, everybody. I'm not sure if you're familiar, maybe for our Floridians in the chat. I was in North Beach today, so I was actually right on the water, and the waves were insane. And I guess this is called the Miami King Tide. So we have really, really high tides. So there's some really interesting videos on Twitter and on, I guess, the news of the waves actually crashing over the boardwalk and wiping people into the ocean. So check those out. Those are insane. Yeah, Dr. Longus says 20% seems so crazy now. Yeah, I mean, I think if rates ever got to 20%, I think you would have a cataclysmic, just total financial lockup and shutdown. So I don't think that's probably going to happen. I don't think it's possible with just the amount of debt we have. The system is already locking up, and we're not even at 4% Fed funds rate yet. I mean, think about that for a minute. I know we're sort of getting sidetracked, but I think it's interesting to think about. The liquidity is already non-existent, and we don't even have a Fed funds rate yet of 4%. That 10-year U.S. Treasury yield briefly for a time got up to 4%, and then once we had that intervention by the Bank of England to sort of save their financial markets, yields have came down a little bit. But think about that. We are already, the S&P 500 is off, I think, 25%. We're down about 9.3% in September alone. And we have just started, in my opinion, the quantitative tightening cycle. Hey, Oliver Crane says, what are your thoughts on the stock market for October? Well, the thing about bear markets is you can have these really, really big neck snapper rallies. And we are quite oversold here. We did blow through the June lows. So I wouldn't be surprised if October is very volatile, but I think we end the month lower in October. Now, my whole thing, and you guys know I've been repeating this ad nauseum, is just not fighting the Federal Reserve, right? Don't fight the Fed here. And I think the Fed has made themselves super, super clear, regardless of if you agree with the policy or not, right? I think that is important as an investor. And I learned this from one of my buddies who runs a pretty sizable hedge fund in Chicago. He's like, look, it doesn't matter if you agree with the monetary policy or not. You need to adjust your portfolio based upon monetary reality. And the reality right now is the Fed is going to take this thing until something breaks. That is just the truth. So my whole thesis is this: so long as the Fed is going to increase interest rates or increase the Fed funds rate and accelerate the rate as they are letting assets roll off their balance sheet, right, which is going to suck liquidity from this market additionally, I think equities are going to have a really, really tough time. Now, one of the things we did talk about, which I think is appropriate to just touch on again, if we remember when this market topped, I think the exact day when the S&P 500, the Dow Jones Industrial Average, and the NASDAQ put in their top, I think it was January 4th. I mean, you guys could fact check me on that. I don't think the exact date matters. But when the market topped, that is right around the time when the PMIs started to roll over. And oftentimes on the stream, well, usually the first business day of every single month, the Institute for Supply Management will post their Purchasing Managers Index. Okay, so the ISM manufacturing numbers. And a reading above 50 signals expansion in the manufacturing sector in the United States. And a reading below 50 signals contraction. Now, this indicator or this piece of economic data is very, very commonly misinterpreted on Wall Street. And I'll give you an example of that. And we've sort of reviewed this many times. A lot of people will just look at the number and say, oh, the PMIs are at 58. Everything must be fine. Oh, the PMIs are 52. Everything must be fine. It's not necessarily the number that matters. It's the direction of those numbers. So for example, you can go back and look at this yourself. What I like to do is I actually like to build an Excel model to do a dot plot of the trajectory of those PMIs. And the PMI, I think, peaked at about 58. Then we got a reading of about 56, 55, 52. So the PMIs are rolling over here. So as the PMIs go, so does the business cycle. And that coincided right when the Fed started to raise rates. So one of the things, so this is the Ferris wheel here at Bayside Marketplace. So one of the things I think that has happened now is obviously the market has priced in interest rate increases. Okay, but what the market has not priced in yet is a potential earnings decline. And I think we may see that as earnings season starts in about 2 weeks or so. Because we've reviewed this many times, especially as it relates to those very high beta growth stocks, right? A lot of those tech stocks. As interest rates go up, the value of those future earnings erodes, right? And vice versa. So I think a lot of the stock market declines that we've seen so far are due to interest rate increases and not so much earnings revisions down. So once Wall Street starts to take that into consideration, I think this could go materially lower. Hey, Dan Zhang is here. Good to see you. This is Wow Tom. What is this place? So this is Bayfront Park / Bayside Marketplace. It's one of my favorite places here in downtown Miami. Usually we approach this section from the front end, but tonight we are walking from the 200 Southeast Financial Center. Hey, Golden's Dawn, this is Tom. My family watches you now. You're currently streaming on house. Hey, wow, very cool. Well, thank you so much, Golden's Dawn, for watching. Oliver Crane says thank you for answering. Appreciate it. Oliver, another thing that I would say was quite interesting. So Nike just reported earnings. And it wasn't so much the actual earnings that I was looking for. One of the things that was really interesting to me is that inventories are starting to build up here like crazy. And we've seen this across the board with a lot of companies, which is sort of throwing me through a loop, because when we did the live stream talking about the latest CPI report, clothing actually increased quite a bit. However, inventories in a lot of these major retailers are stacking up here quite a bit. And I think this has been due to, obviously, the crazy amount of mishaps in the supply chain due to the pandemic. So companies have been ordering. Well, here's one of the things that have happened. Companies have been ordering a ton of product and they haven't come on time. So a lot of the seasonal stuff and the seasonality of the business, a lot of those products arrived after the season. So they're sitting on a bunch of this inventory. So that is probably going to impact earnings materially going forward. And I think you're going to start to see a lot of companies actually revise down their earnings for next fiscal year, which should reflect in the market. But like I said, we are very, very oversold here. Hey, Austin City Limits. Happy Friday to you, my friend. Thank you for being here. Mike C is joining us. What's up, Mike? Welcome. Dusty Cole is here. Welcome, Dusty. Rachel says, hey guys. Tin Man is here. Blue Crew says, good Friday evening. Good to see you, Blue Crew. Trust you're well. Yeah, so Paul Greenwell says, Tom, they're saying Ian did about $47 billion in damages. I can believe that 100%. I mean, some of the footage that is coming out of Fort Myers, some of the footage that is coming out of like places like Naples, Florida, mainly on the west coast of Florida, is really, really heartbreaking stuff, which actually reminds me of Hurricane Sandy a little bit. So really, really terrible, terrible stuff that's happening. I would not be surprised if that estimate is even a little bit short. Hey, Marcy is here. Good to see you, Marcy. Thank you for joining tonight. We are at Bayside Marketplace. Marco up. Eduardo says, my mom is always mad at me for driving no matter the price of gas. Yeah, well, that's another thing. The gas prices across the country are headed back up as we head back into the winter season. Some of you guys were tagging me on Twitter, showing me some crazy jumps in gas prices, especially in California, New Jersey, and Florida. Hey, we have Miss Brown Eyes here. It's TGIF, good to see you, Miss Brown Eyes. Thank you for being here. I see Brian. Welcome, Brian. Billy says, got my Keeping At It book delivered overnight. Going to be my weekend read. Hey, awesome, man. Billy, you're going to like it. Yeah, so Keeping At It, for those of you who are just joining, is a book that I recommend everybody read, because I believe that there's no other time throughout history that's as similar to now as it relates to monetary policy as the 1980 Paul Volcker style era. So I think reading that book will allow you to understand and navigate the financial markets in a period when interest rates continue to go up. Hey Eduardo, good to see you. Trust you're well. So I'm not sure when they're supposed to finish construction on Bayside Marketplace. Maybe next year. But it's still very nice, but about half the place is blocked off. Yeah, Dan Zhang says, Tom, I feel like Miami hasn't been affected by the hurricane at all. It really hasn't. I mean, we got some tornadoes in Broward County and a few touchdown in North Miami Beach, as well as Fort Lauderdale. But besides that, wow, Darren, crazy. So Darren says, hey Tom, so I paid $8 per gallon for 98 premium Los Angeles, California. Dude, that's insanity, man. I honestly don't know how people are going to continue to do it. You know, on previous live streams, we talked about the potential for the American consumer to reach a breaking point. Now, if you remember back to that Stanley Druckenmiller interview we were talking about, he made a very valid point that the average American consumer, well, in total, right, not per person, but the American consumers right now have about $2 trillion, roughly, give or take, maybe a little bit less now that a couple, months have passed, of savings that were built during the pandemic as consumers were able to pay down debts and things like that, wage increases. So that may take some time to work through. But the way things are going and the way that these interest rate hikes from the Federal Reserve are going, and they're still not bringing down inflation, I think we could potentially reach this tipping point faster than originally expected. Because just think about that. If you're paying $8 a gallon, now granted that was premium, let's even just say $5 a gallon, during a time where many employers are mandating their employees come back to work, I mean, that's just expense on top of expense on top of expense. We did get the PCE out today, which is the Federal Reserve's preferred inflation gauge, and almost every single metric in the PCE was higher. I think the only thing that was down on a year-over-year basis was energy costs, which was down about 5.5%. But if you look at food and every other category, we have substantial increases in almost every single category across the board, which we will review tonight on the stream. Hey, 61 says, Tom, Costco Gas Miami Lakes today was $3.15. That's not bad. That's not too bad. Hey, Zozo Bob is here. Good to see you, Bob. I see Vinny Castellano is here, my good friend from Staten Island, New York. Welcome, Vinny. Thank you so much for joining tonight, and hope you have a fantastic weekend, and happy Friday. Grand Street wants a savings, or spending savings for basic needs. Living expenses is insane. This is Grand Street 1. Dean is here, says, hey man, how you doing? I'm doing good. It was a good day today, not as busy, so I'm happy about that. I see British Gray is here. Good to see you. British Gray, definitely happy that you're safe. Joining us from Tampa, Florida. Now, Tampa didn't get the direct hit, thank God. But still, this tornado devastated a ton of people, especially in the Fort Myers area of Florida. Horrible. Derek is here. Welcome, Derek. Let's see who else we have. So this is the corner of Northeast 4th Street and Biscayne Boulevard. Dan Zhang says, during the peak of my gas price, damn. Says you paid $110 to fill up your SUV. Yeah, that's insane. I'm not sure how long that's going to be sustainable for the American consumer, but we'll see. You know, and this comes at a time when more and more businesses are announcing layoffs. Okay, I was actually on a call earlier this week at a company that I consult for, and they were organizing a restructuring. And anytime a business uses restructuring, it pretty much means they're gonna fire people, right? It's just a more professional way of saying they're gonna lay a lot of people off. And we're starting to see this really become more broad-based as opposed to more sector-focused. So we're seeing pretty much every single major tech company do one of two things. Just do outright layoffs, or these broad-based restructuring where they tell their employees, look, you can no longer keep your job and you have a couple of weeks, if not maybe 1 or 2 months, to apply for other positions within the company. Which is pretty much, many people just take the package and leave. You know, last earnings report, Microsoft, I think, spent a record on severance payments as they are laying people off. Google, Alphabet, however you want to call them, not only are they laying people off, they are going through a hiring freeze, and that is usually the first step of the layoff type process, right? Businesses go under a hiring freeze, then they look at the quote-unquote fat that they want to trim out of the business, and then they commence those layoffs. Or they are renegotiating salaries and paying people less in exchange for, you know, you could still work for our company. So I think this is going to be more broad-based. But one of the things that I wanted to talk to you guys about tonight, as we are overlooking the beautiful Freedom Tower here in downtown Miami, and right behind the Freedom Tower is the Paramount building. Now, even though we've been seeing broad-based layoffs, I was reading an article, and I was even talking to one of my friends who's a small business owner. It seems like the labor market is extremely tight, even still, as it relates to small businesses and small business hiring. Now, are you guys seeing that? I know there's many people who watch the streams that are small business owners, or maybe knows somebody who owns a small business. Is that sort of what you're seeing in the marketplace too? That the labor market is still really, really tight as it relates to hiring, maybe if you own a small business or something like that. Hey, Bernard Friedman is here. It's good to see you, Tom. What's up, Bernard? Always a pleasure to see you. We are outside the Port of Miami tonight on this beautiful night. Jackie Chen says, was putting into performance improvement plan in advance so they won't give me a package to fire. Yeah, the PIP, I guess they call it. Yeah, I've been through that. I've never personally been on it, but I know of people who have done the, at my old company, they used to call it PIP. If you're not performing, or you're not hitting your numbers, you know, it's all the corporate bureaucracy nonsense, which I hate. So my heart goes out to you. That's horrible. Hey, Mona D is here. Says, hello, Tom, and everybody. Glad to see you safe and sound as always. Thank you, Mona. I appreciate it. We are coming up on the FTX Arena here at Northeast 6th Street. Tariq says no one wants to work, yet everybody wants an Escalade. Oh my God. Good to see you, Tariq. Eduardo says, I would like to relocate, but horrible people follow me. I don't know who or why. Wow. Hey, Big Talk. Says, guys, if anybody needs work, come to Ireland. Good to see you, Big Talk. Hey, Matt. Says, Tom, I ordered the book of Paul Volcker, Keeping at It. I can't wait to get it. Thank you for the recommendation. Hey, Matt, that's like, I think that's the second person on the stream who has got that book. So that makes me really happy. I think you guys are going to enjoy it. And maybe I'll have to call Paul Volcker and get a little bit of a commission from him. Just kidding. Just a joke. But yeah, again, I'll just sort of reiterate. And I've said this multiple times, but I think it's very important, okay? Because the number one thing that I believe that impacts the equities market, right? You could talk about the broad-based indices or stocks in general, is monetary policy, okay, is interest rates. And as we've been talking about, ever since the lows of the great financial crisis, we've gone through QE 1, 2, 3, QE quadrillion, right? It seems like we've had interest rates at artificially low levels for quite some time now. And I think many investors, including myself, I mean, I was born in 1995, so I wasn't even alive during the last time we had real, true, significant quantitative tightening. I mean, you could probably debate some point in the 90s, but I'm talking about real broad-based quantitative tightening in my investing lifetime, okay? So being that I haven't lived through a period like that, really the only way you can get a feel for that is, number one, to talk to people who have traded or invested through that time, or read and learn from the people who were actually making that policy during the 1980s, right? So what we're seeing right now in the United States is the highest inflation since the 1970s and 80s. And in order to control that, what the Federal Reserve is doing, and it's not even a guarantee it's going to work, is they're raising rates at the fastest pace since that time period. So it would only make sense to read, study, and really, really zone in on that particular time period, which is the 1980s, in which case the Fed chairperson was Paul Volcker, in which case he was successful in killing inflation, but it did come with significant costs. The unemployment rate spiked all the way to above 10%. Many Americans were out of work, but if we look at the long-term aspects of that, once we got inflation under control and once rates were normalized, we went on to have one of the largest and longest eras of economic prosperity the United States has ever seen. You know, that brought us into the 1990s with the tech and telecom boom. So I think it's very important here that we understand how to identify a market cycle, right? A true market cycle. I don't think that we have seen a true market cycle correct. Yeah, you could say, you know, maybe in 2018 or maybe in 2020, but I think those were more corrections in a larger bull trend. I think what we could be seeing now is a complete deflation period in terms of asset prices across the board in equities and real estate, sort of like what we saw in 2008. I think it could be on that scale. So I think for the people who are well-read are going to understand how to capitalize on this situation, and I think we are going to capitalize on this. And I think it's going to be life-changing money that's going to be made here when all is said and done. And we'll keep at it. Wow, Mike C says, Tom, my first mortgage was 13.5%. So put that into perspective. And you know, Mike C, thank you for sharing that, because last night on the live stream, we were talking about how I'm a little bit bearish traditional banks here. Okay, and that may be a contrarian point of view because you may say, wait, Tom, why are you bearish the broad-based banks, particularly the investment banks? Oh, did you guys see that? Hold on, hold that thought. I think we got something in the water right here. Did you guys see that, or was that me? Maybe it was just... Hold on, we'll be on dolphin watch tonight. I saw something jump out of the water. Maybe not. Yeah, maybe not. I don't know. I could have sworn I saw something. Oh, Robert, you saw it too look like a manatee? Maybe it was. I'll keep my eyes peeled. But to Mike C's point, so here's why I'm a little bit bearish, or I've been bearish the banks. And many people would say, well, why would you be bearish banks when interest rates are going up? Which I understand, but hear me out. And again, I could be wrong. This is just an opinion. Okay, this is the first cockroach I've ever seen in Miami. That's the first one I've ever seen here. Man, that thing was disgusting. That was like a New York City cockroach. So here's why I'm bearish the banks. Because we've been in an environment, again, where rates have been artificially suppressed. And with that, that means pretty much, and we did a poll in the chat last night where we said, okay, for those of you who are in the chat right now, and at the time we had about 750 people watching the live stream, we said, how many of you that have a mortgage on your home, right? Whether it's your personal residence, an investment property, whatever it is, how many of you in the chat own a home that you have debt on it and your rate is below 5%? I'm not joking. Probably 99% of people said, yeah, I have a below a 5% interest rate. So what does that mean for a lot of these banks that have historically, ever since, again, the lows of the great financial crisis, have had a booming business in the refinancing, right? Nobody is going to refinance their debt or their mortgage in this environment because everybody that owns a home now has rates below 5%. And I believe today, as of today's close, the average 30-year fixed rate mortgage is going for roughly, I think, 6.87%. And now that's the average, right? So if the average home loan is going for 6.87%, that means that there's people right now being quoted a 7% rate on a 30-year fixed. So that part of the business is gone. It's not like, oh, it's just going through a little bit of a correction. We're in a little bit of a downturn. No, it's gone. Like it went to zero. So there's going to be no profitability for probably many, many years until rates come back down because nobody's going to be refinancing their loans. So that part of the business is gone. Number two, the loan originations business is taking a material hit. So I'm getting a little bit distracted. I'm trying to be on dolphin watch as well as explain this thesis. But anyway, the loan originations are falling off a cliff. Why? Because people can't afford homes right now, because the only reason why they were able to afford them in the past is because debt was so cheap, right? You could afford a payment on a $600,000 piece of property because you were paying a 3% yield. Now, that same $600,000 piece of property at 7%, your monthly payment is more than double. So to Mike C's point, he's like, hey, look, my first property that I purchased was at 13.5%. I wouldn't be surprised if we go back to that type of environment. But the different thing this time is that a lot of the banks were making a lot of money in the refinancing people's loans, mortgages. And I think a lot of that is, well, it has, if we've been paying attention to the earnings reports, has literally fallen off a cliff. So that part of the business has gone to zero. Another bear thesis is that we have to look at IPO activity, or initial public offering activity, which in 2021 Oh, that's a big bummer right here. I hate seeing debris in the water, and that's a plastic bag. That is terrible. That means some sea turtle or something's gonna get caught up in that. That sucks. But in 2021, it was a record year on Wall Street for initial public offerings or IPOs, and investment banks make a killing off of the fees or equity underwriting fees to bring these companies public. So there was record profits across the board in the investment banking business. Now, IPOs have declined 99%. So profits at these banks are gonna fall off a cliff, not only because of higher interest rates, so nobody will be refinancing their mortgages, but the big moneymaker at these investment banks is that equity underwriting and IPO business, and that is also non-existent. So just be cognizant of that. Yeah, Dusty Coles says, great call, Tom. Hate that crap too. Yeah, I mean, to be fair, the waters were extremely rough, and that usually kicks up a lot of debris. Obviously, due to the hurricane, that's probably kicked up a ton of debris and put it into the water, unfortunately. Hey, Ryan Royal says, hey everybody, high rates aren't just a US issue. I saw a video where rates are up to 10.5% in the UK. Yeah, you're 100% right, Ryan Royal. It's not just the United States. We are in a global bond market sell-off here. And that is why stock markets across the globe has really gotten clocked here, for lack of a better term. But you're 100% right. Bond yields are blowing out across the board, and it is definitely cause for concern. But Ryan Royal, good to see you and welcome to Miami. Martin says the water's warm. So I was actually at the beach today, and not for nothing, due to the hurricane, because it's stirred up so much water and pushed it to shore, the water's actually kind of cold right now, which is very uncharacteristic of Miami. Now, if you guys want to see some interesting video here, what I would recommend is go on Twitter, or if you're following me at Walks Wall Street, or if even if you just want to look at it on YouTube, we are experiencing what's called king tide here in Miami. So today in Miami Beach, there were massive waves that were coming all the way up over the boardwalk, and it actually washed a couple of pedestrians into the surf. And they had to call Ocean Rescue to get them out. It was insane. So if you are in the South Beach neighborhood, or really anywhere walking the boardwalk or close to the ocean in Miami, you really got to pay attention, because that tide comes in really fast, and it could catch you off guard and drag you into the water. So please be aware of that. Hey, Andy S. is just raining so much in North Carolina right now. Andy, please be safe. I know the hurricane this storm is insane. It crossed all the way over Florida and then has geared up more steam and now is headed back towards the Carolinas to pound them. It's absolutely insane. Mike C says, I couldn't believe how bad the flooding was in South Carolina today for Ian 2.0. Yeah, I didn't really get a chance to assess the damage, but hopefully it's not as bad as what you're saying, Mike. I think this hurricane is going to go down in the history books to be an absolute record. But this is the skyline of Miami, and this building is a very famous building called the 1000 Museum. And at the top, if you Google it or you watch some YouTube videos on it, it actually has a helicopter pad at the top. It's insane. Beautiful skyline, beautiful day. I think we got something in the water. Let's see. You know, I think they're just basic fish jumping out of the water. I think it's too cold for the water to be dolphins. Hey, Billy says king tide and high surf in San Diego means we leave work early and grab our boards. Nice, man. You know what? Here in Miami, they are very strict about going in the water. I tried to go in the water today, and the lifeguards were just not having it. Nobody was allowed in. Dante Rose is here. Says, hey, Tom, good to see you, Dante. Always a pleasure. Thank you for being here. But we'll quickly review some of the inflation data we got today. I think it's important to note this because this is really the main inflation gauge that the Fed looks at. I'm not too sure what is going on here at the FTX arena, but I think there's about to be a tidal wave of people coming out here because there may be some concert or something. I saw a ton of people going into it earlier today. So anyway, the Fed's preferred gauge showed that inflation accelerated even more than expected in August. The Personal Consumption Expenditures Price Index, excluding food and energy, rose about 0.6% month over month. That is faster than the 0.5% that many economists on Wall Street expected. However, year over year, this is where it gets kind of bad. And I know year over year numbers are a little bit more exaggerated because it's a longer time duration. But the year over year, the PCE increased 4.9%. That is more than the 4.7% expected. So as one of the things we've been reviewing on the stream for quite some time now is that the Fed is very, very set in their ways that they will not pivot, or to use their exact terminology, they will not prematurely pivot until they see concrete, conclusive evidence that inflation is dissipating. And not only are we not seeing concrete evidence that inflation is dissipating, we are actually seeing concrete evidence that inflation is accelerating and getting worse. So from an investor's point of view, and I think this has been confirmed by the market action today, is don't fight the Fed. And I'd like to read you all a very notable and very famous quote on Wall Street that was actually coined by Jesse Livermore back in the day. And that quote is, "There's a time to go long," which means buy the market. "There's a time to go short," which means bet against the market. "And there's a time to go fishing." And I think this is the time to go fishing. And what that means is if you're actively managing a portfolio, okay, if you're a portfolio manager, you shouldn't be buying things here, okay? There's no need to dump money into this market where we're in a screaming downtrend and the Federal Reserve is literally telegraphing and telling us that monetary policy is going to continue to get tighter and tighter and tighter. Now, I think one of the other things additionally that a lot of people aren't taking into consideration is the impact that higher interest rates are going to have on businesses. So we've talked about, and I'll give you a real life example. I've been working with a lot of companies and helping them structure their budgets for next year. So let's say if a company is going to put on a new technology program or a technology project or something like that, oftentimes they don't pay cash for that. They'll take on debt to expand the business or invest in their business. So if debt is getting more and more expensive, well, where do you think that corporate spending is going to go? Do you think it's going to increase? Do you think it's going to decrease? Or do you think it's going to stay the same? You know, my money is that it's going to decrease substantially. And that means corporate profits will probably be lower. Now, if you remember back to the beginning of the stream, one of the things that I said is I believe that the vast majority of this stock market decline has been due to traders pricing in higher rates, not traders and investors pricing in an earnings recession. Okay, there's two different things. Now, one of the things that we always review on the streams is that over the long term, the prices of stocks, equities, indices, whatever you want to call them, will follow the trajectory of corporate earnings. Okay, so if corporate earnings in America are accelerating, they're growing, they're doing well, over the long term, equity indices and the stock market will go up. But when you have an earnings recession, that means stock prices will be depressed or go down. So I believe that there's a very good possibility here that over this quantitative tightening cycle, when we see a material earnings decline, we could see, you know, another 30% lower in the S&P easily. Now, I'm not saying that we're going to get there overnight. You know, bear market rallies, the market could be up 25% in a month and then roll back over. But until this earnings recession that I think we may be getting is priced in, I think a bottom in this market is well far off, so to speak. Andy S is possibly good to see you, Andy. Sabrina Fair says my husband just said Tom is making a good point. Thank you, Sabrina Fair, and thank you to your husband. And I hope you guys have a fantastic weekend wherever you guys are. Hopefully it's as beautiful weather as we have here in Miami. Austin City Limits is Tom, who do you think will win the House and Senate in the midterms? So I'll give you my opinion on that. I'll give you my opinion. Hey, we have Lady O here. It says Lady O celebrates 13 months of membership. Hello, Tom. Happy the hurricane didn't affect Miami. Hey, Lady O, thank you so much for your support. Thank you for being a great moderator. I saw your comment that you went to Italy. So that's fantastic. I know that's your favorite spot. Thank you for helping out with the channel. Appreciate you, Lady O. Much appreciated, and enjoy your weekend and have a great Friday. Who asked that? I forget. Julia says that it could mean layoffs, which is what the Fed is hoping for. Absolutely, yeah. I think you're totally 100% correct, Julia. So I forget who asked the question. It may have been Austin City Limits. But I need to refresh myself on what the question was. Who do you think is going to win the midterms? The midterms. So I'm going to give my opinion, and I will preface this by saying I don't really care who wins, and I just don't want everybody to fight in the comments about the Republicans and Democrats. I love you all equally, and I respect everybody's opinions, whether you are a Democrat, Republican, whatever. I respect you all equal. But here's what I think is going to happen as it relates from a financial analyst's perspective and not a political analyst's perspective. So one of the things I think we are going to have both houses. Excuse me, let me just cross here. I think we're going to see both houses of Congress turn red. Hold on, let me cross. Give me 1 second. Maybe we'll jump on the Metro Mover. I just wanted to get away from those people because they're canvassing about, I guess, a medical marijuana petition, but I already ran into them like 17 times today, so it'd be a little bit awkward. But I think we're going to see both houses of Congress flip to the Republicans. Now, again, I'm not saying that's what I want. I'm saying that's what I think is going to happen. And I actually hope it happens from a financial analyst and investing point of view. Okay, and here's why. If we look at the data, and I think I've said this multiple times before on the stream, and I will give credit to an analyst on Wall Street by the name of Thomas Lee, and he is the CEO and founder of Fundstrat. And one of the things that he said throughout his research is that the equity market tends to perform the best when there's a Democrat as a president. And we have that. We have President Joe Biden, who is a Democrat. So that is one thing going for us. And number two is when both houses of Congress are controlled by the Republicans. Historically, that is when equity returns are the best. So if you're planning on being long the market, it is a very good possibility that we are about to enter one of the most prosperous setups for the financial markets. Now again, try not to get all frazzled in the chat. Think about it from a financial analyst standpoint, not from a political analyst standpoint to say, oh, I hate Republicans or I hate Democrats. That's not the point we're trying to make. It's irrelevant in the investment business. What is relevant in the investment business is making money, okay? And the way you make money in the financial markets is coming to terms with reality. So it doesn't matter if we have a Republican president or a Democrat president. We need to look at the data and say, look, historically the market tends to perform the best when we have a Democrat as a president, okay? And we do have that. We have Joe Biden, President Joe Biden. And when both houses of Congress are controlled by Republicans. And this may be lining up almost too good to be true here, because we've had a significant depression in stock market declines, right? Just this month, the NASDAQ is down 10.5%. The S&P 500 is down about 9.2% in September alone. And the Dow Jones Industrial Average declined roughly 9% as well. So as the midterm elections flow through and we do get that favorable outcome, again, aside from your political beliefs, I respect everybody's, if we do get that political outcome and the Fed is successful in killing inflation, well, we could have one of the strongest bull markets the world has ever seen, if all of the stars aligned, right? That is a big if, but that is what the data says. Hey, RS is here. Good to see you, RS. Welcome, my friend. Mike C says, I think if you mixed up the order of the last 4 presidents, we would be exactly in the same spot as we are today. Yeah, I think that's a good point, Mike C. I think that's a good point. Now, this is what I've always said. And again, this is my opinion. This is a very highly opinionated statement. But I think people give too much credit and credence. Wait, is this an open slot? Oh, it is. I thought this window was just so clear, but it's actually, you could see right in the building. How crazy is this? That was tripping me out because I was like, wait, why is this window so clear? I was like, it literally looks like there's no glass here. And lo and behold, there is no glass. So if you want to have a free place to stay, come right here. Just kidding. Anyway, as you guys could tell, I get sidetracked very easy. But I think people give too much credit to a president when the stock market goes up, and beats the presidents up too much when the stock markets decline. I really believe that. And this goes both ways. Wow, look at this beautiful 1000 museum here. And here's why I think that. I'm gonna give you guys some perspective here. The financial markets really don't care who's in the White House. The financial markets operate based upon the present value of money and the rates, essentially. Can you borrow money at a cheaper rate to finance the growth of your business, or are you borrowing at a very, very high rate, in which case growth of your business is going to be very costly? So it just so happens that Joe Biden is the president right now, and we're having these historic stock market declines, and everybody's throwing their hands up in the air and saying, oh, Joe Biden is the worst. And again, I tend to lean more conservative. I've been very open for that. But I don't think it's really appropriate, in my opinion, to say, oh, the stock market is declining because of Joe Biden. I actually don't think that at all. And I pretty much disagree with everything the guy has to say. It more so has to align with quantitative tightening, quantitative easing cycles, right? And the reason why I say this is if you look at the Fed's balance sheet or statistical correlations here, between stock market returns and the Fed balance sheet, one of the things we'll see is that there's about a 97% correlation between the return in the equity market and the growth or the expansion of the Fed balance sheet. So in other terms, as the Fed buys everything or prints a bunch of money, as they buy mortgage-backed securities, as they buy US Treasuries, and as they cut interest rates to near zero, well, you can pretty much guarantee that the stock market is going to go up, right? But in the inverse correlation there, if the Fed starts quantitative tightening and allows assets to roll off their balance sheet and raise interest rates, it doesn't matter if you have Donald Trump in there right now, stocks are going to go lower, right? So that's sort of my view on that. I think people in general tend to give presidents too much credit when the market is doing good, and they beat presidents up when the market is not doing good. I actually don't think there's much correlation at all, to be honest. But again, that's just my opinion. Hey, D is here. Good to see you, D. Thanks for joining the chat tonight. We are outside of the beautiful Paramount Miami World Center. It's one of my favorite buildings here in Miami. Travelmista says he's a one-term president. I don't see him having a successful second term. Yeah, I mean, maybe you're right. Maybe. I don't know. Maybe you're right. Hey, Estelle is here. It's a beautiful spring day here, Tom. Good to see you, Estelle. Thank you so much. Estelle is joining us from Australia. Thank you for being here. But if you guys are enjoying the live stream tonight, feel free to leave a like on the video and hit the subscribe button if you're new. We tend to go live 5 days a week between New York City and Miami, and we would love to have you here along for the ride. So hit the subscribe button if you are new. Billy says, human nature is we overvalue our losses and undervalue our gains. Kevin Ramsey says, maybe. Let me see if I could adjust. Hey, Michelle K, good to see you. Always enjoy your stream, Toms. Thank you, Michelle. Billy says you can't blame Biden for the market going down, but you can put blame on his politics for making the environment worse. Yeah, I think it goes both ways too. I think you're right. Again, I pretty much disagree with the vast majority of the Biden administration, but just looking at the data and just looking at, especially, I think the great financial crisis of 2008 changed the game as it relates to how the financial system works. Because the financial system quite literally broke in 2008. And now we have all of this modern monetary theory garbage, which is essentially just central banking on steroids, printing a bunch of money. So when we sort of take that, I don't really want to use the word heroin, but I guess I will. I can't think of anything else. When we take the heroin away, the market goes haywire. It's like a crack addict, this market. It's addicted to cheap money. It's addicted to debt. So once the Federal Reserve stops printing, and not just the Federal Reserve, central banks around the world are in a tightening cycle, aside from the Bank of Japan. But once central banks around the world stop printing and giving the market what it wants, which is cheap money, debt, the system collapses in on itself. So we live in a debt-based society where essentially the markets don't function without an in perpetuity perpetual debt issuance, which is very scary. Mike says, how were banks allowed to make bad subprime loans? Lobbying, maybe? Lobbying? All right, you know what? Maybe we'll have a go at the Metro Mover again. We didn't have too much luck last time, but maybe we'll have some luck this time. It's Friday night. We'll check out the Metro Mover. We'll take it all the way to Brickell. Yeah, Will is 100% right. Crony capitalism. And Will, to your point, that's sort of why, you know, whenever the financial system breaks, we always blame capitalism. But if we had capitalism, none of this stuff would be happening. All right, I'm not going to make the same mistake. We have to get on this side. Right? Yeah, this side took us all the way to the Frost Science Museum. So we got to get on this side. I'm not going to make the same mistake. Hey, Joan is here. Welcome, Joan. Happy Friday, TGIF. All right, so we are going to get on this side, and this is going to take us back to the 200 Southeast Financial Center, where I believe I have to change. So we'll do it. I think the train is going to come in maybe 5 minutes here.
Passengers, for your safety, stand back from the platform edge.
So,
allow passengers to exit before attempting to board. For your safety, stand back from the platform
here it
edge.
comes, I think.
Thank you for your cooperation.
All right, so we talked about a lot of negatives tonight, right? We talked about the PCE, the Fed's preferred inflation gauge, really ramping here. The last thing I want to just quickly say is that if we do a deep dive into the report, income and spending also grew, with wages up about 0.3% in August, about the same as July. Energy was down about 5%, housing rose 1%, healthcare rose 0.6%, and food prices rose 0.8%. So essentially every single category in the PCE went up except energy, which is very, very bad news. But here's some good news. Okay, you guys want to know the good news, or should we just continue down the road of depression? Well, I'm going to give you the good news anyway. So as it relates to the stock market, wait, let me listen to this notice. All right, hold that thought, everybody. I'll give you the good news in a second. We're about to get on the Metro Mover. Hey, Jared Covey, what's up? All right, we're gonna get to the good news, but I just want to get on the Metro Mover. I don't really like talking on the train because sometimes people don't like it. All right, everybody, I'll see you on the other side.
This is Park West Station.
I'll get you guys a front row seat.
Please stand clear of the doors and hold the handrails. This train will depart momentarily. The next stop is College North Station. Transfer here 4.
It's the FTX Arena in the distance. we have to stay on for 2
The train
stops
is approaching.
and then transfer.
College North Station. Transfer here 4.
So 2 more stops, I think. At least I think. I'm trying to think of what we did. No, I think we did get off here, I think.
This is College North Station. Transfer here 4. Inner loop.
Inner loop. I think that's what we gotta do.
The next stop is Looking D. Ferguson Junior Station. Exit here for Primar.
Wow, Zozo Bob. So Zozo Bob, do I have to stay on this to go to Brickell? Or should I transfer here somewhere?
Please hold on. The train is approaching. Looking D. Ferguson Junior Station. Exit here for Primar.
So this is where you get the Bright Line, which is a very nice place.
This is Looking D. Ferguson Junior Station. Exit here for Primar. Please stand clear of the doors and hold the handrails. This train will depart momentarily.
This is the inside of the Metro Mover.
The next stop is Government Center Station. Transfer here 4. Metro Rail.
Blues Rider, what's up, man? Alright, I think we get off at Government Center, which is right here. Don't let me forget to give you guys the good news, because we do have some good news here. I may forget to give it to you.
Please hold on. The train is approaching. Government Center Station. Transfer here 4. Metro Rail.
You know what? I think if I stay on this, it will go right to Brickell, I think. Oh, Rachel says get off.
Please stand clear of the doors. Departure of the train is being delayed.
All right, so it's delayed, so we have some time to figure it out. So if I stay on here, will this take me to Brickell? No, it won't, right? All right, I'm gonna listen to Zozo Bob. All right, we gotta go to the inner loop, so we gotta go to the left. All right, to the street, to inner loop. I'll put my hand out so it looks like a video game. Does this sort of look like a video game? It would look more like a video game if we go like this, right? If we move the gimbal up and down. Oh, check this out. Let me know what it looks like out here. How's it looking? How was it out there, guys? I couldn't see the screen on the camera, so. All right. Metro Rail Omnibus Loop. It's not what we need, right? So this is the bus. No, we need out here. I'm wearing a hat today. What do you guys think? Thumbs up, thumbs down? All right, inner loop, here we go. That wasn't too bad. All right, so the inner loop will take us to Brickell. But they did say the train is delayed, so I will give you guys a quick, I guess, tour of what it looks like down here. A lot of vacant space. I think this is the famous courthouse here too in Miami. But if you look all the way in the distance, this is the City National Bank building, or the Miami Tower. And you could see the beautiful Aston Martin building in the distance as well, which is actually where we are going to head to. Now, there's a ton of vacant lots here, but it looks like they're just going to start construction on something. I'm not too sure what it is, but and then here is the Brightline station, which is supposedly really, really nice, Brightline. And it looks like there's a brand new Chick-fil-A. You know, this station does look kind of old though. Hey, Halty 16, good to see you. With the Andrew Yang blue baseball cap, good to see you. All right, let's see when this next train is coming. Hey, the Ellery 1, good to see you. So we were just talking about mortgage rates. I think today is the first day that they're quoting a 30-year fixed above 7%. Now, the average is right around 6.87%, but obviously the average means there's people getting quoted below or above. And I think today people are actually getting quoted above 7% rates on a 30-year fixed for the first time in a long, long time. But as it relates to the equities market, here's actually something that's a piece of good news. Now, if you remember back about 6 months, maybe even 3 months, one of the things I said that we need to look out for is this market will not bottom unless all of the, I guess you can call them the Wall Street bets, Reddit crowd, the buy the dip crowd, all the people during the, oh, I think this is the train. All the people during the pandemic that are like stocks only go up, buy the dip at all costs. The market will only bottom once those individuals are totally blown out. So here's a good piece of news. For the first time, you know, actually I'm going to leave you guys on a little cliffhanger. We're going to take the Metro Mover and then we're going to tell you the news. I should have gotten the other car. Oh, I think I just got on the wrong one, right? Zozo Bob, you said get on the Brickell Loop, look at the signs. I thought you told me to get over here. All right, let's see. Let's look at the sign. Hold on.
An oncoming train is arriving. Stand back from the platform edge. Allow passengers to exit the vehicle before boarding.
Brickell. All right, so we gotta wait for the Brickell Loop.
Manténganse alejado del borde de la plataforma.
Omni Loop. Yeah, it says Brickell's coming in 2 minutes. 2 minutes and 9 minutes, so we got some time. All right, so we have about 2 minutes. All right, 10-4, copy that. If you guys ever need help with public transit, oh, team, we got to go back over there. Look, it says down here Brickell Loop, Omni Loop. So we got to go on the other side. If you guys ever need help with public transportation, ever, I am definitely not the guy for you. If you need financial forecasting or somebody to build a discounted cash flow model for you, I could definitely help with that. But anytime we're talking about public transit, I'm not your guy. All right, we got to go back up here. All right, 1 minute.
A Brittle Loop train is arriving. Stand back from the platform edge. Allow passengers to exit the vehicle before boarding.
Está llegando un tren de Miguel. Manténganse alejados del borde de la plataforma.
All right, I'll tell you guys the good news in a minute.
Antes de abordar.
We have to get on the Brickle Loop train. Hopefully the phone doesn't die before I tell you guys the good news. All right, finally.
Government Center Station. Transfer Pier 4. Metro Rail.
Blues.
Government Center Station. Transfer
Yeah,
Pier
Blues
4.
Rider. Maybe I'm.
Metro Rail. Omnibus.
So I know how to get around New York City where like it's nothing, but in Florida, I only take the bus. I don't really take the Metro mover. You know, I've noticed an interesting correlation. The more confusing the public transit system is in a city, the better I can navigate it. But the easier and more clean cut it is, it totally throws me through a loop and puts me in a pretzel. Natalie says a bit different from the MTA. Yeah, it's a lot more simpler because there's only like 3 lines. The MTA has like a zillion. Looks like we are delayed here. Lemonade says you would love the DC Metro. I'll actually be in DC not too long.
Train is arriving. Stand back from the platform edge. Allow passengers to exit the vehicle before boarding.
Please fasten the door and hold the handrail.
Bob says, Tom, remember the Brickle Loop is always the outer loop. Copy that.
The next stop is 3rd Street Station.
Okay, and we are off. Couple more stops. So you can see city center in the
We are
distance.
experiencing a temporary delay to Brickell on the encountered loop service due to operational difficulties. We apologize for any inconvenience. Thank you.
So if you look all the way in the distance, you can see Brickell City Center. So we have a couple more stops. Hey Julie, good to see you. We're headed to Brickell.
May I have your attention, please? We are experiencing a temporary delay to Brickell on the encountered loop service due to operational difficulties. We apologize for any inconvenience. Thank you. Please hold on. The train is approaching. Riverwalk Station.
Hey, Mike and Kathy, 1974 says, do you know that the 2008 financial crisis had a Republican president? I do know that. I do. Emilio J says, teach these people about dollar milkshake theory. They need to know. Ooh, that was a good stream, the dollar milkshake stream. We may have to do another revisit of that. All right, Riverwalk Station. All right, 2 more stops and we should be good. We just have to go over the river.
The next stop is 5th Street Station.
There we go.
Please hold on. The train is approaching. 5th Street Station.
You know, we'll get off here. Because I think it's going to be a better view here. All right, team. We are finally off of the Metro Mover. Hopefully you guys enjoyed that experience. So if you notice this, we usually actually stream the river walk here and go over this bridge. And we look at this vacant lot, which is going to be a big building of some sort. Hey, the Ellery one says, Tom, what is the rainbow object on the other bridge? So I think this is where the Bright Line or the Metro Rail, maybe some of the Miamians in the chat could chime in. That is a different train track. I think it's the Metro Rail, I think. And the Metro Rail station is this big one right here. But I'll show you guys the river and then we'll go to Brickell. All right, so here's the good news. My God, this has been a cliffhanger of cliffhangers. So we've been talking about the markets will really only bottom once a lot of these retail investors are shaken out of the market, right? So all of the buy the dip at all costs crowd, all of the, stocks only go up, a lot of these GameStop people, the meme stocks, all the nonsense, right? The Doge, what was it, the dog coin they were doing something? Once all of that nonsense ceases to exist, and once all of these people have lost their money, and look, I'm not saying this in a way to be harsh. You may say, oh my gosh, Tom, you're too harsh. You sound a little bit arrogant, but this is just the reality of how markets work. Markets bottom when investors, particularly retail investors, capitulate and lose all their money. That's just the reality. It's not a rule I made. It's just a fact of life. So last week was the second largest retail selling week in 5 years. So that's the good news. So we may be getting closer. I'm not saying the market is going to bottom now, but we're getting closer. We are definitely getting closer here. So I'll repeat that again, if I could find a way how to get out of here. It's like a maze. Last week was the second largest week of retail selling in the last 5 years. So you're really starting to see people capitulate here. And I think the reason for that is because, remember last night's stream? We were talking about a lot of those particular stocks, the very high beta frothy growth stocks, a lot of the particular stocks that are in the Cathie Wood ARK Innovation ETF. A lot of these stocks are now down 85 to 90%. You look at Zoom Video, you look at Peloton, absolutely got its head chopped off. You look at Twilio, Okta, all of these very high beta stocks that everybody thought they could only go up. Well, now they've gone through severe valuation compression, right? And if you remember back to the Behind the Street newsletter that I wrote about 6 months ago, I said the first stocks to really face the brunt of the declines during a tightening cycle are the very high beta growth stocks who have no present value earnings, but maybe they have some earnings far out into the future, right? Because as interest rates go up, the present value of those future earnings decline. And that's why a lot of the stocks that, Cathie Wood would own in her ETF have gotten crushed because there's no earnings there. So again, I'll repeat that. Last week was the second largest retail selling week in 5 years. I think the first largest retail selling week was a couple days before the market bottomed in 2020 during the COVID pandemic. That was the number one in the last 5 years week that retail was selling and capitulating here. So the reason why I bring that up and say it's good news, not because I want people to lose money, quite the opposite. If we learn how to invest the proper way and understand how to evaluate businesses, understand how to evaluate, let me just cross the street here. This is like a little weird intersection where there's no traffic lights. And if we really pay attention to the fundamentals and say, okay, finance is all about evaluating the future value of companies' cash flows. You guys want to know something a little bit ironic? I almost just face planted here, and I almost tripped over crutches. How ironic would that have been? Tripping over crutches, breaking my leg over a crutch. Anyway, so that's the good news. We are starting to see capitulation here. People throwing in the towel, and it's like this through every cycle. I mean, I know I'm only 27 years old, but this is all I do besides tech sales. Is I study the financial markets. This happens like clockwork, time and time again. Now again, I still think the market has some ways to fall here, because one of my main theses is, look, the market has now priced in higher interest rates. The market has not priced in earnings declines. So that will probably be another topic for another stream. Hey, Diamond Dave is here. This is Heads Up Tom. Hedgies, tanking heavy. Good to see you, Diamond Dave. Julie is here. Marcy, welcome. Charles D says, once retail investors tap out, institutional investors will buy the dips. Yeah, I think you're right. More so along the lines that I'm more concerned about is, look, Q2 earnings we covered. Q2 earnings were good. However, if you look at the guidance side of the house, many businesses refuse to actually give forward guidance. And now we're starting to see some companies come out of the woodwork and give profit warnings for the next fiscal year. So I think over the next couple quarters, we're probably going to be doing a lot of live streams that go along the lines of something like this. Goldman Sachs analysts drop their earnings outlook for the next fiscal year. Or a company is warning of margin compression, right? So I think we just need to be aware of that. We need to be cognizant of that. We have now broken the June lows across all the major equity indices, and the bond markets is really what we need to be looking at. You know, we had to have the Bank of England intervene here, and we've only just started quantitative tightening. And already the bond markets are in total cataclysmic meltdown. So, hey, the Ellery says, I would love for Tom to explain the reason why Tesla declined or decided to split its shares. I'm a holder, but don't understand why this is done. Well, it's done for many, many reasons. I'll give you an example. Of another stock, and it'll make sense here in a minute. My phone may die, so if I cut off, I appreciate you guys joining. But first of all, a stock split doesn't change the valuation at all. Okay, there's no material change in valuation. So a lot of the times when you watch like CNBC, the traders will come on and be like, oh, this is going to be a great catalyst for the stock. It's not. You shouldn't be trading solely off the base of a stock split. The valuations don't change. There's just more shares on the open marketplace. So for example, let's say if a company is a 2-to-1 stock split, you own $1,000 worth of stock, you will still own $1,000 worth of stock. You will just own more shares, right? Because they just essentially slice the pizza pie into more slices, but valuation stays the same. A couple of reasons why they do this. Google or Alphabet did a stock split mainly because they wanted, I think, they want an in to the Dow Jones Industrial Average. And number two, and I'm using air quotes here, air quotes, it makes the stock more affordable to the masses. Now, I'm using more affordable in air quotes because if you look at a stock like Berkshire Hathaway that trades in the hundreds of thousands of dollars per share, it doesn't mean that's a more expensive stock than, say, Tesla, just because it trades at, I don't know, $300,000 a share or something like that for the Class A Berkshire Hathaway stock. It just means that there's less shares outstanding. So when a business goes through a stock split, let's say, you know, Amazon was trading at $3,000 a share. So for the average guy and average girl, they look at that and they say, oh, wow, you know, I could only afford one share of Amazon, 2 shares of Amazon. But if you do a stock split and it brings the price down to, let's say, $200 a share, something like that, the perception there is it's more affordable. Now, again, I'm using air quotes because a $1,000 stock and a $1 stock could theoretically have the same valuation. It just matters about the shares outstanding. So whenever you see a stock split, there's no material change in the valuation of the business. It's just essentially splitting up the company into more pieces, if that makes sense.
No, they were like, what is
All right, so we are now outside of beautiful Brickell City Center. But team, I think we're gonna have to end the stream a little bit early tonight, but I think we covered a lot because my phone is about to die. We talked about the Federal Reserve. We did a quick recap of the month of September. So historically, the month of September is always the worst performance for the stock market. And if you remember, at the very, very beginning of this month, I said that I think that trend is going to continue, not only because we have a historical trend here going on, but because we are in the midst of a massive quantitative tightening cycle. So for the month of December, the Dow Jones Industrial Average ended down about 9%. The S&P 500 ended down about 9.3%, and the NASDAQ lost about 10.5%. What else did we talk about? We talked about the PCE inflation is ramping at a faster pace than expected, which leads us to believe that we will continue to have very, very tight monetary policy for the foreseeable future. We will be live tomorrow, 8:30 p.m. Eastern time. So please hit the like button, hit the subscribe button if you're new. We do these live streams about 5 days a week between New York City and Miami, and we would love to have you along for the ride. If you want to know a little bit more about my thoughts on the financial markets or just continue the conversation further, scan the QR code on your screen.